Hi, everyone. My name is Yassine Elmandjra. I direct digital assets at ARC, and I'm really excited to be going through the Bitcoin section of our 2024 Big Ideas. The way that we laid out the section in Bitcoin is twofold. There's a section focused on Bitcoin allocation, or really the growing role of Bitcoin in investment portfolios, which is obviously a top-of-mind discussion in light of a Bitcoin ETF approval. And the second is really a year in review, Bitcoin 2023, showing some of the dynamics at play, some of the growing fundamentals that we've seen at Bitcoin, and what to look for coming into 2024. So without further ado, we can jump right in. For the first slide, I think it's important context to actually maybe take a step back and explain a little bit ARC's history with Bitcoin research. And really show why this slide in particular is really just an extension of research that we first published in 2017, where the title of the research paper was Bitcoin Ringing the Bell for a New Asset Class. We believe that based on just the broad portfolio characteristics that Bitcoin presents, its investability, its history, its basis of value, its correlation of returns, that Bitcoin merits not just an independent allocation in traditional portfolios, but is a completely independent asset class relative to traditional asset classes. This slide right here really shows side by side relative to the major asset classes like commodities, equities, bonds, and real estate, why Bitcoin doesn't really neatly fit into any of those buckets and merits really a column for itself. And so you can see here that Bitcoin's history, its investability, its basis of value, and its correlation of returns, its governance, and its use cases are all independent, distinct, and unique to traditional asset classes that allows for it to really insinuate itself as an independent and separate asset class. And now, and as we'll get into, as we see this evolution in the market, I think investors are starting to pick up on this reality. As a traditional investor, as any investor, one of the first things that one looks at, when comparing asset classes is just how returns have been relative to each other. Bitcoin, has outperformed every major asset over longer time horizons, and has annualized an average 44% return, and you compare that to traditional assets, which is average just around 6%. The idea here is that over any single year, Bitcoin can be up or down, but over longer time horizons, Bitcoin has been, quite provocatively ahead of other major asset classes. Now, given Bitcoin is an asset that trades 24/7, that is highly liquid, that might be up or down in any given day with its significant volatility, oftentimes investors, might focus exclusively on that without kind of taking a step back and really recognizing what the long-term returns and implications of Bitcoin are as a long-term investor. And I think this chart is quite a provocative chart that suggests that to successfully invest in Bitcoin, we believe that you should be focused on, the time that you are willing to hold Bitcoin versus the timing or when you're actually allocating into Bitcoin. What this chart shows is that historically, investors who bought and held Bitcoin for at least 5 years have profited no matter when they made their purchase. And so oftentimes in some of the question that investors ask is now a good time to be buying? Bitcoin is up 50% in a year, Bitcoin is down 80% the next year, when should I be buying? What this chart suggests is, you should be understanding what Bitcoin is, which will allow for you to have a long-term investment horizon, which will then, I'd say over the long term, allow for a successful investment in Bitcoin, because we don't believe Bitcoin is this get-rich-quick scheme. We believe it is a long-term investment. And oftentimes, internally, we like to say the number one rule of Bitcoin is to forget that you own any Bitcoin. This chart suggests exactly why you would want to apply that. Correlation of returns is one of the biggest characteristics or measurements for why Bitcoin or other asset classes should be worthy of an allocation in a traditional portfolio. Oftentimes, Bitcoin's volatility again obfuscates its diversification benefits and its low correlation with returns. And as you can see from this chart, it's really one of the few asset classes that has consistently low correlations with other asset classes. And so when you're thinking about maximizing your risk-adjusted returns, something like diversification is a really important component to determining whether or not an asset is suitable for a broad or more diversified portfolio. I think now in its 15-year history, Bitcoin's low correlation of returns as the market has expanded suggests why it is now quite a provocative asset to have in a traditional portfolio. This slide really extends on that narrative and shows that if you were to, as an investor, optimize for maximizing your risk-adjusted returns, Bitcoin should play quite an important role in doing that. And that role, and as we'll get into in the next slide, is only growing. These charts effectively show what the optimal portfolio allocation is if you were to have traditional asset classes as this universal set of assets to allocate into. And you can see that in 2023, that mix is quite heavily favored in favor of Bitcoin, with close to a 20% allocation in Bitcoin if you wanted to maximize your risk-adjusted returns. The chart on the right shows the kind of what that tangency portfolio is, and so you can see here that each of the assets have an expected risk to reward or return to volatility. All of the individual assets kind of sit below this equity curve, and the purpose of this exercise is to, based on the previous 5 years of asset class returns, what would that optimal mix look like if you wanted to maximize your Sharpe ratio, which is effectively a proxy for risk-adjusted returns. This is another a different angle to approach kind of the same conclusion and shows what that allocation looks like and how that allocation has grown and evolved since its early infancy. You can see in 2015 the optimal allocation was just under 1%. We've at ARK allocated our first exposure to Bitcoin in 2015 when Bitcoin was trading around $200, and have obviously seen a ton of maturity in the asset class since 2015. And so when we talk about numbers like 6.5% or 6.2% in 2022 and 19.4% in 2023, I think having the full perspective that these numbers weren't necessarily the same numbers that were recommended in 2015. It really kind of just shows the maturity of the asset class relative to traditional asset classes. So in 2015, Bitcoin, since its inception, had wonderful price returns, but the volatility was too high, where the optimal allocation was much less than it is today. On average, that optimal allocation has been around 4.8%, or just around 5%. So if you were to take, let's say, the average optimal allocation over the last 9 years, that is around a 5% allocation. What would be the impact of this allocation into Bitcoin? If you take the $250 trillion of global investable assets, if investors were optimally allocated into Bitcoin, this could have a significant price impact on Bitcoin. A 1% allocation into Bitcoin based on that global investable base is around $120,000. That average allocation is $550,000. And the optimal allocation in 2023 could have upwards of a $2 million impact on Bitcoin's price. We believe, based on these estimates, that in the assumptions that we're making, that this is actually a relatively conservative estimate, if indeed there was allocation, there was optimal allocation, for a few reasons. The first is that this is taking the entire 21 million supply cap as the denominator of this calculation. Instead of the outstanding supply of around 19.5 million. So if you were to divide by 19.5 million, that actually increases these numbers by a few percentage points. Additionally, I think an underappreciated point around Bitcoin supply dynamics is much of that Bitcoin is lost, and much of the Bitcoin is unavailable for marginal demand to be absorbed by marginal demand. So there's something called a price multiplier in Bitcoin, which many have estimated can range between 4 to 20 times a dollar inflow, which suggests that for every dollar that let's say is being used to buy Bitcoin, there might be a 4 to 20x multiple on a market cap, or how that's reflected in price. Overall, I think that the primary takeaway, especially as we see more institutions adopting Bitcoin, is we expect in the next 10 years for Bitcoin to be a sizable allocation in traditional portfolios. I think it'll likely start with that smaller 1% to 5% allocation, but as investors start to recognize the diversification benefits, the sort of risk-off component that Bitcoin offers, and sort of the broader case for Bitcoin as this digital gold, we expect this allocation to only increase from here. Now on to Bitcoin in 2023, really kind of an overview of the resilience and recovery of Bitcoin after challenges in 2022. I think 2022, after the massive contagion that we saw in 2021, was really a year of recovery. And to see Bitcoin thrive in the way that it has, and to see it recover in the way that it has, I think in our 10 years of covering Bitcoin, we've never been more optimistic about the fundamentals and the narrative for Bitcoin as an institutional asset. 2023 was a year of recovery. Bitcoin, based purely on price and returns, had quite a magnificent year, up 155%. Increasing its market cap to just under $1 trillion. There were some, major news events throughout that I think, we'll get more into, but that signaled, both positive and negative. But overall, I'd say that most of the news events were quite positive, and the ones that were negative were really just, a function of some of the contagion that we saw in 2022. And really just resolutions from that contagion. Looking a little bit at the on-chain fundamentals, Bitcoin's price crossed above its on-chain market mean for the first time in 4 years. We published a piece this year titled Coin Time Economics. It was published by David Puel, our on-chain Galaxy Brain research associate. That was able to develop a very reliable demarcation point between risk-on and risk-off Bitcoin markets. And you can see how Bitcoin has, if you take a look at this on-chain market mean, which you can think of as just the average cost basis of the market, tends to be a reliable indicator between, call it, risk-off and risk-on periods. So whenever Bitcoin's price is below the on-chain market mean, this tends to be a risk-off period, or we tend to be consolidating in a bear market. And whenever Bitcoin's price is above the on-chain market mean, this tends to indicate a risk-on period, or we are, expanding in a bull market. You can see the last time we crossed over from risk-off to risk-on was right after COVID, where we dumped to just under $4,000, and then ultimately for the next 2 years, made our way to new highs, peaking at around $69,000. You can see we've made that same crossover, and appears that the November 2021 bottom, in line with FTX's bankruptcy of around 15,800, was a global cyclical bottom, and we have seen quite strong recovery since. For more on this, I would highly recommend reading our Coin Time piece, which you can find on ARK's website. As mentioned, 2023 really provided important answers to the crises in 2022. And this slide really shows some of the major contagion that we saw across the industry. Everything from, the Luna Terra collapse to Genesis's bankruptcy, and how there were some open questions in 2022 as to how things would resolve themselves. And to our pleasant surprise, the resolutions have come, I'd say, quite earlier than we expected. And you can see how some of these resolutions have really seen the light in 2023. FTX is obviously the probably biggest household name in the entities that, I'd say, were part of this contagion. And it has been quite encouraging to see some of the resolutions with FTX, in particular Sam Bankman-Fried, who has now been convicted on 7 counts for fraud related to its collapse. Other entities like Three Arrows Capital, Celsius, BlockFi, Genesis, and Terra Luna all seem to be on their way to full resolution, whether that's paying back creditors or facing some indictments and charges that suggest that justice is and will continue to be served. Perhaps one of the most provocative charts in this entire presentation was way Bitcoin acted during the regional banking collapse, and how, and as we'll get into, it has really evolved. The narrative for Bitcoin as a risk-off asset has evolved, and this specific event is, I'd say, the strongest testament to Bitcoin as a risk-off asset that we've seen in its history. As many of you might be aware, in early 2023, there was a historic collapse of major U.S. regional banks. The Silicon Valleys, the Signatures, the Silvergates, the First Republics of the world, all collapsed. And in that same week, we saw Bitcoin price appreciate more than 40%, which really highlighted its role as a hedge against counterparty risk. Bitcoin operating independent of traditional financial institutions, and operates, with or without the acceptance or the need for these traditional financial institutions to sort of exist. I think many investors caught on to that reality and really used Bitcoin as a safe haven during these times of uncertainty. For the first time, I think in quite a long time, there's been a surge in a use case outside of transaction settlement or the facilitation of sort of money and settling money and storing and transferring value. Obviously does not come without its own controversies, but I think Bitcoin inscriptions, which was launched in January of 2023, has really indicated a growing role for the Bitcoin network beyond just transaction settlement. At a high level, Bitcoin inscriptions introduce a unique numbering system where each Satoshi you can now have identifiable data and images and text inscribed in a single Satoshi, or the smallest unit of Bitcoin. So unique to inscriptions is that everything effectively occurs on the base layer of the Bitcoin blockchain. This is much different than what you see in alternative blockchains, where there's some sort of second layer for, let's say, non-fungible tokens. Bitcoin inscriptions are much different, where you can basically have these non-fungible units of account in the base layer. The implications of that is we've seen a surge in basically transaction fees where there is a demand for inscribing data on this small unit of Bitcoin. And in that inscription, people are willing to pay higher fees. Now, this has sparked debate on some of the impact that inscription has on network congestion, transaction sizes, just broader block space. And I think in our view, whether or not Ordinals succeeds, I think is independent of the fact that this is a product of the free market. And in the spirit of Bitcoin being this open, permissionless global network, something like Ordinals represents, I think, really healthy experimentation and innovation on Bitcoin, and is a testament to the free market dynamics that Bitcoin offers. And so we've been quite pleasantly surprised that the pickup in inscriptions, how that's affected transaction fees, how in speaking to miners, miners appear to be benefiting and appreciating the spike in transaction fees. And as you can see from the chart to date, there have been upwards of 50 million inscriptions on the Bitcoin network. Just as in 2022, in the face of contagion, Bitcoin's fundamentals didn't skip a beat. 2023 was no different. And in fact, we saw a massive improvement in 2023 relative to 2022. As you can see from some of the major highlights in network stats that indicate broader network fundamentals and health of the network, Bitcoin's market cost basis increased from $380 billion to $427 billion. Again, the market cost basis, I'd say, is a strong proxy for long-term holding behavior, and we like to see cost basis increase over time because that effectively sets a strong floor for Bitcoin's price. Hash rate, as you can see in the chart, which is the proxy for network security, has also hit an all-time high in 2023, now standing at around 500 exahashes per second. It is by far the largest computing network in the world by sheer raw operations per second, and is an indication that the demand to mine Bitcoin is only increasing, of course, independent of any hardware advancements, which at this stage have become increasingly marginal. The supply of Bitcoin last moved is around 70%, last moved in over a year. So this suggests that 70% of Bitcoin is not moved in a year. And when we look at Bitcoin as this long-term store of value, to see the holding behavior have a long-term bias is extremely encouraging and reinforces the narrative of Bitcoin as this digital gold. At the same time, we're seeing net new owners of Bitcoin. While not a direct proxy, Bitcoin addresses with a non-zero balance, while not a direct proxy to number of users, has increased from 43 to 51 million. The long-term holder supply, which is defined as supply that hasn't moved in at least 6 months, is around 14.8 million of the 19.5 million circulating supply. And then the transaction count, non-inscription related, is up to 367,000 from 256,000 in 2022. So independent of inscriptions, we have seen a pickup in activity, which is quite encouraging as we enter this new expansionary phase. Another quite provocative chart that suggests the institutional maturation of Bitcoin, the infrastructure being more regulated and secure following the contagion in 2022, is the exact response that we have been encouraged to see, and how Bitcoin's market dynamics are much more favorable to welcoming institutions into this asset. You can see that Bitcoin futures is now mostly commanded by the CME, where open interest hit a record $4.5 billion on the CME and surpassed Binance for the first time late in 2023. If you notice the growth of CME's open interest, relative to not just Binance, but to FTX, see why, how strong of a signal this actually is. Just a year ago, there was more open interest on FTX than there was on the CME. And following the November 2022 collapse, that has obviously since changed. Reinforcing the narrative that we saw during the regional banking collapse, we're seeing that Bitcoin is evolving into a reliable risk-off asset. I think Bitcoiners and the perception of Bitcoin has always been as this risk-on asset, in line with other technological revolutions, highly volatile, for quite aggressive investors. I think Bitcoin is actually one of the first assets that for the first time has both risk-on and risk-off attributes. And 2023 was, again, the first signal that shows that Bitcoin should be seriously evaluated as a risk-off asset. And if you were to define sort of what a risk-off asset is and the characteristics that it presents, it's along these 5 axes. So a risk-off asset is an asset that is safe, that should preserve capital. Bitcoin operating as a decentralized network and its distributed open source nature protects it against counterparty risk and arbitrary asset seizure. As we highlighted in the previous section, the diversification benefits of Bitcoin being historically low to traditional asset classes is, I'd say, a strong reason for Bitcoin as a risk-off asset, as it provides this kind of buffer against market downturns and doesn't behave, as we saw with the regional banking collapse, similar to sort of the traditional financial markets. Bitcoin, as we also saw, is a long-term investment and has continued to deliver long-term price appreciation, outperforming major asset classes in its last 10 years. Bitcoin is also highly liquid and accessible. It is one of the few assets that trades 24/7 globally, borderlessly and independent of traditional rails. And in times of uncertainty and this broader macro global uncertainty, that value proposition is all the more important. What are we looking out for in 2024? Well, the first is we've got a Bitcoin spot ETF launch, and that has been a long time coming for not just us, but the broader industry at large. It sets the stage for Bitcoin's growth by offering investors a direct, regulated, and liquid way to gain exposure. Many institutional investors who were on the sideline and were not comfortable allocating into direct Bitcoin now have a mechanism to do so in an extremely efficient way, and we are excited to see how those dynamics evolve relative to institutional investor adoption. The Bitcoin halving is coming this year as well, which we are paying very close attention to. It's a reinforcer of Bitcoin's predictable monetary policy, where every 4 years, Bitcoin's issuance rate gets cut in half. And now, in April 2024, we expect that the issuance rate will cut from around 1.8% to just under 1%. With the Bitcoin spot ETF launch, we expect growing institutional acceptance as well. This is exemplified by not just some of the names of the issuers that you see in the Bitcoin ETF, but the broader narrative that these issuers are evolving. Larry Fink, CEO of BlackRock, who was quite an outspoken skeptic of Bitcoin just a few years ago, now has not only issued its own ETF, but is now beating the drum for Bitcoin as a potential flight to quality. And then finally, in light of some of this growing infrastructure, the maturity of the asset class, we expect to see more favorable regulatory developments following the bankruptcies of some of these major entities that cause much of the contagion. we expect to see the U.S. a little bit more favorable to Bitcoin and the asset class as large, recognizing that if they aren't, they will likely lose out on generational innovation. In speaking with some of the senators that we have in the U.S. On our Bitcoin brainstorms, it has been quite encouraging to see that the shift in the narrative and the embrace of Bitcoin is certainly underway. With that, I thank you very much for listening to the Bitcoin section of Big Ideas 2024. You can find more information at ARK-Invest. We publish monthly reports on Bitcoin. We have monthly Bitcoin brainstorms. And we look forward to receiving your feedback here. Thanks, guys.